Hi, everyone. Mike White here. Welcome to this week's vlog post. Another solid, steady week of rates going lower, bond prices improving. A lot of the indications going forward um, are that we're probably having, that long, steady stream of rate increases and potential rate increases now behind us, where pretty much everybody's in agreement that the next Fed move will, certainly be lower. When that happens and by how much that happens, it's still hard to tell. As you know, we're going to have economic data both today and tomorrow that are going to impact, market movement. But again, I think as we've talked about before, we've seen a steady stream of information and data coming to light that shows that all the Fed increases that have happened over the past, couple of years have found their way into the marketplace, are really restricting economic activity, and the Fed is even starting to be aware of it. They've even acknowledged the fact that the data collection and the things that they look at need to be improved. And with that said, we're seeing the bond market improve and rates go lower. And you know what? That is important. It is a good thing, because after all, who doesn't like paying less for the same thing? Yes, lower rates are here. They're coming. How much lower they're going to go, how quickly they get there, and what the impact is in the market will remain to be seen. The hope against hope is that it is a slow and steady march. We all know rates go down much slower than they go higher. And we also have to be very cautious in this environment, not to have this lower rate environment become the whole picture of what's going on, because again, it can lead to some issues, potential challenges that can cost you, your client, opportunities, money, what have you. Because, well, the markets fail to understand what the consumers, most of which don't know, is that all rates are not the same. The issue isn't whether rates in general aren't coming down. It's the impact of what the markets are doing to your individual borrower, to your individual circumstance, because we know that programs, loan to values, credit scores, property types, all of those things come into the picture to a much higher degree than most people believe. And so when people go out there and say, what's the rate today? It's sort of like asking, what's the temperature in the United States today? A lot's going to depend upon where you are, your specific location. And we've come to understand mortgage rates are not a commodity. It's not like Bitcoin. It's not like oil. Hell, even oil has different prices per barrel based upon the quality of the oil itself. There can be a big difference between the value of a price of oil, whether it's how it's graded out. If it's the light sweet crude most refiners like, it's much higher price than what is that heavy, difficult to refine, crude oil. The reality of it is, a lot has to do with, yes, oil in general, but oil specifically. Same thing in the loan business. We've all seen it. We can really vary. And as rates go lower, we're going to continue to see the quote unquote emotional attachment to numbers. We all know that 6.99 is not 7%, right? The emotional attachment to 6.99, saying 6 and not 7, even though the actual difference in monthly payment or cost to that consumer is marginal at best. The emotional attachment to starting the word with 6 or 5 or whatever is a big difference than saying 7 or 8 or 9, however. And it's really important that we understand that even in our own business, there is a very wide range between pricing. The best possible circumstances to which somebody could borrow mortgage money and the worst possible circumstances at the highest possible price for somebody to even get approved for a loan can be very, very different. And so we have to be, cautious. The other thing that we have to be cautious about is getting people wrapped up in the fact that rates are going to go lower and giving them target dates as to, oh, we're going to see this percent rate by this point in time, or this is going to happen or that's going to happen. You never know in a marketplace, and you never know how it impacts that borrower. And the other thing that has to happen is you have to make it very clear to that borrower that the circumstances are such where it is really important that we understand that rates move every minute of every day. And if you're going to have somebody that's going to be sitting there calling you, 20 times a day, what's the rate, what's the rate, what's the rate, especially when they're in a situation where they're not under contract, they don't have a closing date, they're not, it is way too stressful for everybody involved, and it's not the point. The point is we have to look at this from a pragmatic standpoint, and that is buy the house. The house itself is a much bigger issue than what the rate will be or what it can be into the future. And what I mean by that is yeah, we could probably see rates go lower, but in that time frame, what's happened with the price of that house? You got somebody sitting there well, I'm gonna, rates are gonna continue to go lower. I saw online, rates are gonna, the Fed's gonna cut rates in the springtime, and rates are gonna be lower in the spring. And yeah, but meanwhile, the house that they were looking at went from $400,000 to $425,000, and then went for $25,000 over asking because there were a lot of people looking, buoyed by the promise of lower rates. So what happens? They increased their competition. There were more people bidding, drove the price of that house up. Because what have we seen over the last few years that most people didn't believe? And that is, housing bubble didn't happen. Housing prices didn't go down. Housing prices have remained strong. Were they as strong as they were a few years ago? No, they didn't go up 15 or 20%. But going up 3, 5, 6, 7% a year on something that is worth 300, 400, 500,000, 800,000, $1 million is a significant increase. And so the challenge that you run into is any gains that you hope to make because your interest rate on that house went lower were wiped out, because the house that you were going to buy, you had to borrow and put up more money to get the same thing, which is why you've got to understand that in this circumstance is, especially now, find the house, lock in the price of that house. Once you're under contract, then you've established the value of that property. You've established the price of that property. And while the interest rate on that loan may fluctuate, it may even go down further in the future. The good news is you've locked in the price of that house, and you can always refinance down the road if the conditions are such that it makes it beneficial. And that's where a lot of people miss out on the markets, is they sit there and they wait for the bottom, and the bottom doesn't happen. And I caution you to just look back not too long ago. For those of you who've been around, 2, 3, 4 years, how many people do you remember when I first started putting out the bumper stickers about interest rates going higher? Rates not 4% yet. And then 5%, 6%, 7%, 8%. I told you the market could move. It did move. And people were shocked. What about all the people who sat there saying, well, I'm going to wait for rates to go back to 2 before I buy? How'd that work out for them? Those people may never buy a house. You don't know that we're ever going to see those numbers again. If we do, sure, they could refinance, but they didn't buy the house. So the house they didn't want to buy at 4% interest at $300,000 is now $400,000 a few years later, and they still can't buy that house, and they may never buy that house. How'd that plan work? So, we talk about this. It is very personal. Rates are very emotional. Nobody wants to pay more than they need to. But you can always remember a very simple sentence. You buy the house, you rent the rate. If you go in there and establish that price and buy that house, and you go out there today and buy that home and lock in your mortgage, rates may be lower in the spring, they may be lower in the summer, they may be lower next year. Nobody knows. Nobody knows for sure. Nobody will guarantee. And for all the people out there who are prognosticating, rates are going to be here in the spring, rates are going to be there in this summer. I bet you there's one thing that I know. I know that they did not sell off everything they own and bought mortgage bonds today. Because if they were so 100% positive that mortgage rates were going to drop dramatically, then why wouldn't they go out there and take every last dollar that they could raise and sink it into mortgage bonds right now? Why wouldn't you go out there and accumulate all the mortgages you could at 6 and 7%? Because if rates were going to fall to 5 and 4 and 3 or whatever it is that they're predicting, why wouldn't they like to be holding 6 and 7% mortgage paper that they would be getting a better return on or could sell off for dramatically improved prices? And the answer is, yeah, I do believe rates are going to go lower, and I believe they're going to go lower over time for sure. But that shouldn't stop you and shouldn't stop anybody from understanding the value of locking in their deal on their house today. Because if rates do go lower dramatically this spring, this summer, like some people would have you believe, okay, the possibility exists that looking at that and saying, what, it's going to stop? Are you going to be happy if you could get 5 and then rates go to 4? And how many times you want to play that game? The point is, if you can lock in your monthly payment now, if you can lock in the price of your house now, and I know you're going to pay attention to those borrowers. You're going to keep them in the loop. You're going to see when it's worthwhile. Many lenders out there right now are offering a free refinance down the road. But the thing that we have to guard against, especially with our referral partners, is people getting in the prediction business. Because getting in the prediction business generally never ends up well. Because if you are right, then you were right. Well, good for you. And the person waited and they did what they did. But what if you're wrong? If they buy that house now, they can refinance later. If they don't buy that house now, they may not be able to buy that house later. So as always, watch the economic data this week. Pay attention to what's going on in the market. Have a straightforward conversation with your clients and your referral partners. And above all else this time, enjoy your Christmas holiday. Friends, family, coworkers. This is the time of the year that we're, looking at this and being very grateful for, what we've been able to accomplish and what we've been able to do. Many of you out there who are watching this had good years despite what other people will tell you has happened in our industry. We'll get into more of that, next week approaching the new year. But for those of you who are on vacation, enjoy yourselves. For those of you who are working, take advantage of the opportunities, because there are people out there looking to buy houses. There are people out there getting pre-approved every day. And just spending a few minutes each day paying attention to your voicemail and your emails and speaking to your customers can be very beneficial, can be very productive and profitable week. So as always, questions or comments, Mike, imptcoaching.com. If not, we'll speak to you again next week. Take care.